welcome to the Ellsworth Advisors April monthly update. I'm Kuennen. This is my partner, Miele. And today, as usual, we'll start off with a kind of an economic update for the month, what's been happening, and then jump into how that's affected our portfolios, what worked last month, what didn't work, and a little bit of an outlook on what we see coming down the pipe the next couple months. Cameron, you want to lead us off?
Thank you, Kelly. Good morning, everybody. Hope everybody out there is staying safe. By way of disclosure, the information, the numbers that I'm going to present come from the U.S. Bureau of Economic Analysis, U.S. Bureau of Labor Statistics, and there's some commentary from the Wall Street Journal. First quarter GDP fell 4.8%. Not something that's going to shock everybody, but this really does confirm that the COVID-19 pandemic has pushed the U.S. into a recession. Most states are still on stay-at-home orders through May, if not going to be extended longer. So we expect second quarter GDP to show another loss. Could be significant, could be ugly. We've seen a mixed bag in earnings so far. Had some beats and had a lot of misses. A lot of companies taking away their guidance. And so it's been a rough quarter. It looks like it's going to be a rough first two quarters. That could extend into the third quarter, but we're hopeful that in the summer months, the economy starts getting back on its feet. People start getting gradually back to work. There's one commentary from the Journal that I found just absolutely striking, and this is from Friday's Wall Street Journal. April's employment report, to be released Friday, will almost certainly show that the coronavirus pandemic inflicted the largest one-month blow to the U.S. labor market on record. Economists surveyed by the Wall Street Journal forecast the new report will show that unemployment rose to 16.1% in April, and that employers shed 22 million non-farm job payrolls, the equivalent of eliminating every job created over the past decade. So in total, the U.S. economy has shed more than 30 million jobs in March and April. And just think about that. We've gone from the lowest unemployment in U.S. history to unemployment that now is going to rival the Great Depression. In fact, this is the highest unemployment we've had since the Great Depression. And some economists predict that we'll surpass the Great Depression high water mark at 25% unemployment. So massive unemployment. We're also looking at airlines, oil producers, hospitality, retailers, all expecting to require massive bailouts. Kelly, I mean, the bottom line is the spending by the U.S. government to try to get the economy back moving, to try to help people, to try to save industries is going to be unlike anything we've ever seen. It'll probably rival the New Deal. I mean, this is very much, we're in a Rooseveltian era where it's just going to be a lot of government money, a lot of propping up of the economy. President Trump is coming out with a major policy announcement on coronavirus and their expectation for reopening the economy this week. It's going to be fascinating to see, but the printing presses certainly have not been turned off. So I expect a lot of volatility, a lot of uncertainty, and we're going to see some swings.
Absolutely. No, we had a nice bounce off the lows in March. April was a good strong month up, and the reality is we like to equate it to what's happened in the past, but obviously every time it's different. And one thing to remember with the government bailouts, if you want to call it that, or the government printing of money, however you want to term it, but that provision of excess dollars and support, social safety net support. What's unique is that every major country in the world is doing the same thing. So it really comes down to a game of relativity, and relatively speaking, the U.S. is still the cleanest shirt in the dirty laundry, if you want to call it that, or hey, we're still the strongest country in the nation or on the world, in the planet, and hey, we're going to move forward on this. It's hard to throw the current conditions into past economic models. The models continue to evolve, and it's not going to fit into the old parameters. We're definitely moving into uncharted territory, but if we were sitting here 50 years ago, we would never imagine where things have gone from a financial market standpoint to an economic standpoint. We could have never envisioned it, and we're in changing times. I mean, that's just the reality, and usually these changes come gradually. This one definitely came quickly. Unemployment numbers are staggering. How long they'll stay like that, it's really hard to say because the whole employment complex is changing. Businesses are going to be rethinking how they're hiring, how they're staffing, how business is being done.
Yeah, a lot of work from home, no more probably huge call centers, people on top of each other, 4 feet apart at cubicles. I mean, this really is going to be, it's going to be a dramatic shift in how we get our jobs done.
It's good, yeah, exactly. It's hard to imagine what can happen. I think, I would not be surprised if we see some kind of basic universal income for the country. And that doesn't mean we're going to socialism, but it very well could happen. Who knows what's going to happen here? And it all comes back to, from an investment standpoint, fueled companies that, can generate profits, have strong, solid businesses, have good balance sheets, they're not over leveraged, they're going to do well in any kind of environment. They always have, and that's just, that's how capitalism, that's how human beings work. Well, and that's been our focus from the investment standpoint.
There has to be winners, even in a down market. Now,
Absolutely.
maybe your winners are the companies that retract less, but there are always going to be winners. And usually those winners are your high quality companies with great balance sheets, and that's always been kind of the hallmark of your investing style.
Exactly. So let's talk about the markets in general a little bit. Like I said, April was a great month. Biggest up month in history, maybe?
Yeah.
So in the Dow Jones in April was up 11.08%. For the year, though, it's still down 14.69. And I'll back up a little bit. These numbers are through the end of April, and they come from Y Charts as our information source. S&P 500 for the month up 12.68%. For the year, now only down 9.85%. So we're now in single digits on the S&P. The MSCI, which measures the developed non-U.S. countries, for the month, kind of the week is showing 6.29%, and year to date, down 18.62%. Emerging markets, they were actually up 9% for the month. Year to date, they've hung in there pretty well. Usually, emerging markets in a tough environment tend to be the worst performers. Year to date, they're still down 17.02, and in the small cap arena measured by the Russell 2000, April was a good month, up 13.66%. Year to date, small caps are still down 21.45%. So that's how the general markets did. How that translates to our major portfolios. Growth with income portfolio for April was up about 6.5%. Year to date, still down about the same, still down about 6.5%. Price potential, we lagged the indexes a little bit in price potential for the month, only up 10.76%. And year to date, we're down 12.89, so we're kind of between the Dow and the S&P on the price potential. Dividend yield for the month up 6.86. For the year, down 12.37. Dividend yield, a little bit of a laggard. A lot of our holdings in there, they're domestic stocks, but with a lot of international exposure. So I think that's probably been a little bit of a drag on dividend yield. And then in our small cap portfolio, for the month, up 10.45%. So we did lag the index, but year to date, we're only down 15.98. So from an index standpoint, we're killing the index on small caps. So that's working out pretty well for us. So in general, I think Cameron, summed it up pretty well. We have to expect the volatility to continue. Earnings season started a couple weeks ago. We still have companies coming in and announcing earnings for the first quarter. And I expect rockiness here. I don't really see, we saw our lows. We came back about halfway from the big pullback in the equity market. We're kind of hanging around that halfway point right now. I can see us languishing around. Definitely, historically, I think we talked about this on the last call. You typically do see a retest of the lows. Who knows? We don't know if that's going to happen or not.
They're such dramatic lows. I hope that doesn't happen.
Yeah, so we can't go all in at this point, but we want to be cautious. We don't want to move out of the market because there's definitely room for upside surprises. I think a lot of things are going to be driven right now around headlines, whether it's around the coronavirus, the economy, people getting back to work. That'll continue to evolve. I think the worst case scenario isn't really panning out, so news may be better than expected. From a COVID standpoint, from an economic standpoint, it's just going to be really lumpy coming out because different parts of the nation are under different rules. So you have different pieces of the economy improving more quickly than others in different regions. So it's going to be very, very scattered on where you're getting returns. And once again, it's, by focusing on individual companies, we don't have to necessarily worry about what the market's doing in general. But the reality is general market movement will affect individual stocks in the short term. But ultimately, those individual companies will do their own thing in the longer term. And that's really how we're trying to approach things at this point in time.
Well, you look at, for example, e-commerce. I mean, how many people are sitting at home right now buying stuff? I mean, I know that we're having a package from Amazon show up every day, sometimes multiple packages a day. But you think about e-commerce, technology, poised to do really well in this stay-at-home environment. Obviously, brick and mortar retail, not so much. So again, to your point, it's about picking and choosing the right companies, the right opportunities, the right industries, and it's not about being all in on the entire market. It's finding your spots and attacking those spots.
I agree. Other than that, like I said, we got to expect some volatility. We're trying to stay nimble on the investment side of things. Most clients have plenty of liquidity to provide for monthly distributions that they're taking and any other kind of known big expenses. I guess one of the things that's happened, Cam mentioned a lot of online shopping, but in general, what I'm finding in talking with clients is people's savings accounts and checking accounts are growing.
Yeah.
Because people are not spending as much money, which comes back to the old dichotomy where what's good for the individual, saving money and becoming more financially secure by saving money,
not often good
isn't that good for the economy. So from an economic standpoint, we want people to spend money, but in these times, people are accumulating money, which ultimately will put us in a stronger spot. It's just, the economy getting through all this, and it's going to take a long time. Unemployment, who knows how long till we see those low unemployment numbers we saw back in January. Will we ever see those again? I don't know. It's hard to say. But it's not the end of the world. We'll get through it. We've gotten through worse. And the government's going to do whatever they can to keep people comfortable and safe.
And we've said this before a number of times, but it's never been truer. If you have not looked at your mortgage in the last year or two, now is definitely the time. I mean, I've seen 30-year mortgages at 3.25%, 15-year mortgages at 2.875%. So even if you refinance your mortgage last year, check it out, get in contact with your bank because you might be leaving dollars on the table by not looking at a refinancing today.
I agree.
I'm not sure we're ever going to see, and I said that a year ago, but I'm not sure we're ever going to see rates this low.
Yeah, it's a good simple point. And the nice thing about refinancing is, you end up with basically a skip month, so that helps from a cash flow if you're not working the hours you have been working, or if you've been displaced in the short term, that can definitely help things out.
So if you have any questions, we're always here. Please feel free to reach out to us and stay safe, and we'll talk to you again next month.
Thank you.